Hey everybody, it's Coach D here from TackleTrading.com. Happy Friday today. It happens to be Friday the 13th. And what we're going to do in this video is I'm going to show you how to roll a put option up and out. And this is a really simple but important trade management technique that can help you keep the cash flow coming in. So I've got an example here, if you come over here and look, on FCX, that's Freeport McMoran. And we've got some naked puts. So I'm just going to highlight this for you. And I like to use the old layout on TOS just because it gives me my Greeks right there in plain sight. And we've got this position here on FCX where it sold 10 contracts of the November 2020 puts with the $14 strike price. And it's pretty much at maximum gain. And it's got 7 days left to expiration, and it's just not worth waiting around for that to expire worthless when we could roll this option up and out to bring in another credit. Now, let me go ahead and show you here. I'm going to go switch over to the Analyze tab and wipe that clean and erase that all off there. Okay, and so this is the position here, and I was already kind of playing around with what I was going to do on that, so let me get rid of that. We've got the $14 put. They were sold for 26 cents, and right now we could buy those back. I can go ahead and create a closing order. We can buy those back for a penny, meaning we get to keep the 25 cents times 10 contracts, so $250. So I'm going to go ahead and send that in and see if we can get filled real quick. Now, you can do a rolling order as well, but I thought I'd just show you how to do each leg individually. Okay, so now that we've got that locked in, you got the 250 some odd dollar gain on that. I'm going to go ahead and we can just go highlight that. You know, it's going to show now that we don't have a profit and loss for the day. So we made $5 today on that, but it's closed the position out. So now I'm going to go add a simulated trade here, and I'm going to go out to the December 20th contracts, another 35 days. So I'm going to these contracts right here, and I'm going to sell a put, and I'm going to follow my simple rules on this. And let me show you the stock chart first, just to show you that it still looks like it's in a really nice upward trend. It's got a really nice upward trend in a little bullish retracement above the 9-period moving average. Prices are moving up. We can go ahead and sell another naked put on that because it still has a nice little bullish posture. So I'm going to go ahead and pick my strike price by my general rule, and I like to look for deltas on stocks, particularly in this particular price range. I like to look for a delta of about 15 or so, closest to 15. And so when I look at that, we've got the $17 put options, and they have a delta of 14. So let me just highlight those there for you. So $17 strike price, and they're going for 26 to 27 cents. We should be able to pull the 26 cents. That's just a penny bid-ask spread, and it's got a delta of 0.1465, so basically just right there at 15. And again, these have 35 days to expiration. So I'm going to go ahead and put that into the Analyze tab, and I'm going to do the same position size. I'm going to go sell 10 contracts on that. And to get this risk graph to look right, I'm going to have to take off the old stuff just to make sure it's not in there. And I'm going to come up here to this calendar, and I'm going to set this top calendar up here in the top right there. I'm going to set that to the new expiration date out in December. So I'm going to roll that forward to December. These expire on 18th of December. So I'm going to go ahead and set that to the expiration date. And you'll notice this light gray area on the chart. Now, this is what's called a probability cone, and it's based off of a 68.27% probability model. And the strike price of 17 is going to, and with the break-even point, puts you right outside that probability range. Now, there's basically about 3 things I look for when I'm selling a naked put. One is the delta rule, which we've already covered. We talked about the delta of 15. 2 is that I make sure I'm outside that probability cone. And I can go show you on a stock chart what that really is. I've got a probability layout here on this chart where I'm showing a 68% probability model with the purple line and a 20% probability model with the blue line. And I'm using what's called a probability of expiring cone. It's a default indicator built into the Thinkorswim platform. And you can just use the 68% model. And again, to add that to your chart, you would just type in probability of, PROB, probability of expiring cone. You add that to your chart. Now, I've already got those on there. And what it would tell me is, hey, This red dotted line right here on the chart, that's showing me the December 18th expiration if you look at the date. And so these are the price points. So it's saying, look, about 1680 is right there on the cusp. And I also want to make sure I'm down below like a support zone or below moving averages. So 1680, 17 bucks puts me right there. And I don't mind owning the stock. I actually wouldn't mind owning the stock at all. It's a great little company. It's got a nice little upward trajectory. Owning the stock's not a bad thing in this case. And if I sell the 17, that would put me down below the 9-period moving average, down below the 20-period moving average, down below the $18 support resistance neighborhood. And if I feeling okay aggressive, I can get it down here at that $17 strike price. Now, if I wanted to be less aggressive, I could go down to the $16 strike price and take a little bit less money, and that would even get me down below that 50-period moving average. But I'm pretty comfortable with the $17 strike price. So I'm going to say, hey, I'm going to make a promise to buy this stock at 17 from now till the 18th of December, and they're going to pay me 26 cents in advance. So my break-even point is going to be 26 cents lower than 17. So that'll put the break-even point down there at 1674, 1674. And I'm going to go ahead and confirm and send that order in. I'm just going to edit that just so you can see. You make sure you're getting the bid-ask spread. You want to get the mid price, and that's the same as the natural price. So I'm going to go ahead and send that in. And that's going to actually bring in, again, $26 per contract times 10 contracts. That's a $260 maximum gain minus the commissions on the trade. And so now we've got that trade in there, and I'm going to go ahead and set this price slice to break even. And I'm going to put it on the chart. So I'm basically going to set the one price slice to break even. And based off of today's date and the expiration date and the current measure of implied volatility, they're giving me an 84.68% probability of that stock expiring worthless, meaning expiring out of the money there. So I'm pretty comfortable with that as well. That means there's a 15.32, and you'll notice that's pretty close to our delta of 15. That's kind of why I picked that, because it's a little bit of a hasty way to get the probability model. The other thing I always like to look for is on the option chain, they give you a ballpark. They say this stock price is going to stay, in the range of plus or minus 256. And if I look at the current price of $19.93 and I subtract that estimated up or down price of $256, the $17 strike price is lower than the estimate of implied volatility, meaning that, again, the odds are in my favor. So that's a type of trade that gives you a statistical probability on the edge. It's, again, worst case scenario, you end up owning the stock at 17. It's a good company. We don't mind owning the stock anyway. They're going to pay us now for simply making the promise to buy that stock at 17 between now and the 18th of December. So, again, we have 35 days till expiration, and that gives us a positive time decay in the account where each day, right now, it's going to pay us about $10.39 in positive cash flow. And they are tying up about $1,965 on that. And so at the end of the day, if you can make $260 off of a $1,900 margin requirement, that's well over 10%. And so that's a really solid ROI. And that, ladies and gentlemen, is how you roll a naked put up in strike price and out in time. We went up to the $17 strike price from the $14 strike price that was max profit. And we brought in another 26 cents for selling the 18th of December put option and simply making a promise to buy the stock at 17 anytime between now and the 18th of December. And we get that cash flow and income. And, it's a pretty good little trade. If you liked this video and you learned from it and you enjoy the simple teaching style, make sure you hit the like button and then the subscribe button as well, and subscribe to the Tackle Trading channel. We're always putting out great content each and every day, and we have a 15-day free trial that you can check out on our website where we have each week we put out our scouting reports, we're putting out our blogs, we're putting out all kinds of things like our coaches show and our traders lounges, and then we're on YouTube every day for our halftime report. And again, we have an awesome, probably the best community out there as far as trading and investing communities go. You want to be a part of our group because you got like-minded people and we all come together and we have a lot of fun doing it. Smash that like and subscribe button.